Hey guys, super happy to be here once again. And today I'm very, very happy because Zach Marks is here. And, Zach is a very special guy because I don't, interview people that went to CFA on a regular basis. And they have a really, really, really diversified experience. And it really makes me interested to get in touch and to ask the most relevant question for understanding their relation to the quantitative industry and how the quantitative industry itself has been impacted with more and more people come on board, even from the business side as well. So very, very happy. So without further ado, Zach is a pleasure to have you here. How are you today? And before we're going to be starting, I'd love if you can present yourself a little bit more to the audience. And yeah, very glad for the opportunity to have you.
Sure, yeah. Afek, thanks for having me. I'm excited to be here. I currently am the Chief Investment Officer of Vineyard Quant Capital, based in the United States, in New Jersey specifically, just kind of right outside the city. And yeah, I've been in finance for a bit over a decade now, I guess 12 years ish. Served in a number of roles, but yeah, this has been the most interesting and challenging so far. And luckily things are going well, and we found a persistent way to keep things going. But we're in tumultuous times now, so excited to be talking about it and looking forward to this.
Of course, we're going to be diving deep. Just to give a hint to the listeners who are actually listening to the podcast. So we're in the middle. We're in March 18th, which is in the middle of the war between the U.S., Iran, and Israel. So that will be giving you guys a direct relation to what is actually happening right now. So I would like to start with you, Zach, from the end, and I would like to ask you. 12 years in the financial industry. Right now, you're serving as a CIO of Vineyard Quant Capital. I would like to ask you, how have you been through, like, what have you been through the journey to be enough qualified for a role as a CIO? What do you think it's necessary for a CIO as an ability or as a skill to have in order to manage? Exponential AUM allocations.
Yeah, good question. Right. So I guess just as a build up, I started my career in market data and got to work with a lot of interesting different types of firms, from asset owners at pension funds to insurance companies to hedge funds, kind of spanning the gamut. And you got to try to see, or got experience to see, um, what is everybody's different strategies. So just because some hedge fund might have a holding period of 3 days or 5 days or one day, I'm also working with guys in asset management that have 2 year, 5 year, 10 year different holding periods. So I think I got to see kind of under the hood what drives buying and selling decisions for a lot of these different institutions, um, which I thought was really interesting. And that's kind of what we tried to bake in at Vineyard, kind of what is driving buying to selling decisions across the institutional space, and then marrying it to, my last role was at Seeking Alpha, which I moved over to after working at S&P. And I got to see kind of what drives retail buying decisions, which they're becoming a bigger part of the active markets seemingly on a daily basis. So that's kind of what I've tried to build at Vineyard, and it's been successful so far. But yeah,
So
basically,
just 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 to have a clear understanding of what a veneer is all about is like the intersection or the aiming intersection between retail understanding of like the bias of what actually drives their decision process towards a very diverse holding period for a hedge fund, and then you know do some congruency between the two, and that's what really drives Vineyard.
yeah, that's right. So basically, at Vineyard, I started off as a more fundamental guy, which is why, I kind of fell in love with investing because of Warren Buffett, and I read all of his letters and tried to follow him and Charlie Munger for a long time. And it was learned quickly that, even the best fundamental guys had a difficult time covering, more than 100 companies, or, 200 at the absolute maximum. So what can you do to solve that problem? And I saw, a lot of quants on Wall Street were solving this problem by basically creating an algorithm to say, I'm a fundamental PM. Tell me, based on all of this data that you are going to commingle together, make me a list of stocks, or tell me what companies I should be focusing on, whether it's, I like companies that are growing earnings, or I like companies that have low ownership, or some view in the world that you like. I want to cover 4,000 of these companies. So do it for me systematically. So
Mhm.
we basically combine a lot of factors together to come out with kind of what we want and how we view the world, and how we view kind of what an excellent quality company should look like, and what companies are then going to have the biggest kind of probability of price, capital appreciation, and return to shareholders.
Mhm. I come from data science background, and I don't count myself as a data scientist, but I do have a data science background, and I would like to ask you, like, if you want to scale exponentially from from fundamental perspective, being able to look at 200 to 200 simultaneous companies, to scale to 4,000. I guess that you work in clusters, so you're actually clustering all of those companies into categories, and then you have like a much more underlying understanding of what's actually happening in between those clusters and in the cluster itself. So I would like to ask you, how do you build a cluster, or if you do work with a cluster, how do you gather those companies in order to give you as a fundamental PM a clear and concrete stand out to get a clear and concise decision.
Yeah. So, I mean, in terms of clustering, we do kind of grade things on or rank things relative to peers in there. So we define peers using GICS definitions. So I think the answer is we try to, bucket things into what we think their closest, sector or industry match is going to be. And I think that's, it's definitely important, something that, looks expensive kind of in some cyclical industry was probably very cheap compared to, I mean, software company, or, very stable subscription revenue growth companies. So it's definitely important to kind of frame things relative to what, companies trade at based on sector, industry, or, just overall business model.
Mhm. And okay, but do you ensure that those buckets are orthogonal to each other? Because you do use gigs, you do use the Greeks, and I am sure that there is some sort of correlation in between those categories. But how much is it is orthogonal, um or correlate to each other, just to have a clear sense of how do you actually think of it.
Well, yeah, I think the correlations are not static, right? Like, for example, in a, macro
Really, the
event
market
day,
are chaotic.
say it one more time.
I'm saying that the markets are very chaotic environment.
Correct. Yeah. So we have different, I guess, rules for when correlations change. Like, right now, um, I think, risk is obviously elevated. Credit spreads have widened significantly. I think a month ago, the entire market was expecting rate cut today, and I think now there's zero, close to zero chance for a rate cut. And I think that the market's now not pricing one until July. So I think with risk, inflation, elevated, things change in processes, and they need to, right? I mean, you know, software. I think software is a great example from this year, right? Like, people had viewed software as like a unbelievably quality company, undisruptible moat. And with Claude releasing new features every day, it felt like we saw a different kind of industry sell off in software every day, whether it was the asset management industry first or um, kind of, Atlassian sold off, which was like a stable, like giant of that's never going away. I mean, Adobe has been selling off, and I think that's a really important thing to think about. Like a lot of these correlations change dynamically. So I guess to bring it back to your question, like how do you? Your question was right. How do you deal with correlations among these different kind of sectors or industries? Was that the question?
Mhm.
Yeah, I mean, I think the answer is you have to be dynamic about it, and you have to kind of change with when the market is changing, right? So if one thing we look at and respect a lot is like price momentum. When price momentum is correlating among a bunch of these different sectors and industries, you need to be dynamic and change to make sure you're not, overly exposed to kind of one sector or one industry or in general, like an entire kind of segment of the market that's going down kind of un you know unbid at one time.
Mhm. Yeah. Okay. And okay, after the separation to the different categories and obviously understanding how do you think of it, I would like to take a step back and or to dive even deeper into the way that you're actually constructing it. So we have started the discussion with the statement that you are trying to align the intersection between the retail pressure that it's like continuously increasing, like in terms of adoption to um, new markets, new assets, and so on, and different holding times and periods for different hedge funds. And my question is how do you build the category itself? Like, what are the most important factors that you're looking at? Obviously, correlations are uncontrollable, and you would like to have some control over the categories that you're building. So I would like to ask you as a PM, what do you think about it, and how do you build it inherently in order to make it understandable, even if the market are not really understandable?
Yeah, I think part of it, right, is having kind of forward-looking data points inside your model, right? So, one of the things we look for is, what's changing. If you're just backward looking, right, at fundamentals, and I think that's part of the discussion, right? Alpha's changing constantly. Like, if you look back, what did Warren Buffett do really well? Like find net nets, things that were trading at low valuations
But
relative
net,
to what they earned in the
yeah, but net
past.
nets are not existent anymore.
Correct. Exactly. So what changed? Where are new pockets of alpha forming? And I see, today we're seeing it um, completely different. Where value, I think, has been a lagging factor for 10 plus years, I guess, until this year. It's actually done quite well. But so it's just making sure I think that you're staying up to date on where edges can be found and what's changing. So I think a lot of it is having forward-looking data in your model and updating it constantly. So one of the things we look at a lot is consensus estimates, where analysts kind of upgrading, downgrading stocks, and then is it happening across that sector or is it idiosyncratic? Is it stock specific? Um, and then kind of how is the market reacting to those changes? So, and then also where is there dispersion kind of in a lot of those rankings too? Like is there a big outlier across where Wall Street thinks something is going? And if
Mhm.
so, kind of why is that? And is there data that can kind of help you solve that problem systematically? So
Mhm.
I think a lot of it for us is having forward-looking data and making sure it's up to date and accurate.
Yeah, but in terms of the quantitative industry, and it's really interesting because you operate as a chief investment officer, and I interview quant research, and if they have forward-looking data points in their model is completely lying. No data leakage is allowed, and you do set up some forward-looking points to have some certainty and understandable stops in order to really understand what is actually happening. And for me, really interesting because the quants are unable to have forward-looking points, and you set up forward-looking points in order to understand what is actually happening, which is the complete opposite of
I'm
what's
sorry, what do
actually.
you mean they're unable to have forward-looking points?
So if they will have forward-looking points in their model will have like a strict data leakage. And if the model has data leakage, it is complete overfit. And if the model is overfit, you're unable to execute it and to deploy it to the market. And
Well,
but
I think those are right. Those are two different things. I think
yeah, those are two different things completely. But I would like to ask you, how do you set up those forward-looking points? Because the quants are unable to really even think about it.
no, I don't know that's necessarily true. Like I've worked with many that use forward-looking kind of data points. I mean, I guess when I say forward-looking data, I mean today's data. What are their expectations in the future based
So
on today?
in terms of expectation, okay.
Correct. Yes. It's not to say, all of the kind of data I use is point in time data. What do we know today? What do we know today? And that's that's a huge, I guess, piece of this, right? Like there's no look ahead bias whatsoever. I mean, the point in time data we use is best in class. I mean, great example of the look ahead bias is you find a lot of different vendors that don't have point in time data. If you're not using point in time data, is for example, I'm just going to pick a random company. IBM says they earned $100 worth of revenue on February 1st. Next quarter you come back and they found, well, we only got $90 worth of revenue. A lot of people will go back and change that, and including IBM, they'll reflect that in their fundamentals that they actually only earned 90 that quarter. And many people, when they run back tests or run simulations, will have that 90 reflected. And there's a big kind of look ahead bias in there because at first the market actually knew that IBM had earned $100 at that piece or at that
Mhm.
time. So having this point in time data where you can look back and see that shift is instrumental to making sure that you don't have
So
any kind of
it's
data
like a
leakages or look ahead
fingerprint.
bias.
It's like a fingerprint that you're looking at.
Correct. Yes, exactly. It's a matrix of data where you can see what changed not only during that period, but also across time.
Mhm. And okay, that makes it even more interesting. So having a fingerprint of data, so you do have a matrix of the data, so you're actually making a signature of the data point that you're interested in having in your database, and looking forward, like hypothetically we're 2 month later, and you do have that same fingerprint, is it still valid to look at that matrix that you have captured a signature 2 months ago? Or how do you capture the right data? How do you make like your own calculations or your own understanding of how the market was shifting towards your expectations to optimize it properly? Which I think it's a hell of a mission by itself to optimize those fingerprints and your understanding. But yeah, let me know.
Yeah, no, that's I think that's a really big piece of it, right? So it's I mean, I think there's a few things, important pieces in there, but definitely having the right data to look. I mean, in the real world example we're talking about today, a month ago, maybe 6 weeks ago now, the market was pricing, I don't know the exact definition, but per exact percentage, but the market was pricing with almost certain probability we were going to have multiple rate cuts this year, right? Now that has gone, it's the narrative has completely shifted. I think they're pricing one rate cut maximum now. It's not till July. So if you only had today's value of only one rate cut for the rest of the year, and you sent that back in your simulation to a month ago, you have massive look ahead bias, right? So having these different viewpoints or in a concrete timeline that you can reliably backtest and reliably kind of train your model on or optimize, as you put it, is crucial to forming a systematic strategy.
Mhm. Yeah, okay. So do you so okay. Now it gets more interesting because I suppose to have one of the one of the authors the author of one of the books that really stands out in systematic equities and systematic trading equities obviously. And we have spoken about how to construct those training hypothesis into being systematic systems by the end of the day. And you're saying that having those metrics over the timeline, that is a major force to build those strategies. Now I'd like to ask you, how do you look at it? How do you look at the data in terms of building more training ideas or training hypotheses?
Yeah, good question. So I think one of the things we look for is to make sure, number one, that I guess is it predictive? Like, does it have a good IC, and is it have enough kind of samples to make sure that what you're looking at is clear and
Just a quick clarification. When you're saying I see is the information coefficient, correct?
correct. Yes,
Oh,
exactly. Yeah, yeah.
no.
So does it have a good IC? Is the breadth high kind of on that IC as well? And then one of the things we like to see is to make sure that the kind of quantiles you're scoring it against are linear. So, ideally quantile 1 is scoring the best, and quantile 5 or quantile 10 is scoring the worst. And then also when you're kind of adding it into a model, as you don't want to overfit. I think if you continue adding more parameters, you're probably going to overfit your model. So making sure that it's orthogonal, right? Like what you already have is not capturing the same thing. So, if you're looking at a simple example in the kitchen, if you're trying to cook something, right? Like if you put something on the in the microwave, I guess, and you want to cook something faster, like is turning on the oven too gonna help it cook faster? Or raising the temperature in your house gonna help it to cook faster? Maybe slightly, but it's probably like 100% correlated. Heat. It's probably 100% correlated with where you already have. So you're just levering your bet into that factor. That's
Mhm.
probably not a good thing. Yes, it probably is going to improve your results if there's a positive skew or positive kind of spread in that factor. But over time, it's going to cause you to have more variance, given that you're really just levering your bet into that one factor.
Mhm. But you know, if you have mentioned information coefficient, but coefficiency it can appear with the same time windows that you're looking at. So meanwhile, if you looking at a period, that period is highly positive, and you do have like a positive skew or something. So you do have some common denominators for the same time for the same period that we're actually speaking about, and those coefficiencies might not be orthogonal by the end of the day. So,
Yeah.
so those features are not orthogonal right now, but you are not looking for correlation, but you do look for orthogonal features. How do you actually craft it or get an underlying understanding of what you need to do in order to build your hypothesis from it?
Yeah. I mean, I guess our process, I mean, number one is run that, you know, factor back test in isolation, see is it predictive that I see. And then, you talk about time periods. I mean, one of the things I think is important to look for there is like, is there seasonality? The simplest example, if you're looking at like a sales growth factor and you see, okay, like this factor like really works well, especially, I think this has been alpha decayed away, but sales growth used to work really well coming out of the Q4 period for retailers because before people really recognized what seasonality was, you used to see this massive sales growth in
Mhm.
retailers after the holiday season. Similarly, you saw sales growth in car sales after the summer when new models came out. So I think seasonality is really important to look at. I think in terms of looking at time periods. or time periodicity. And then I think also, testing these things in and out of sample is really important. So what that means is, okay, you've determined that, this factor is very positive from, 2010 or 2015 to 2020. What would have
Hmm.
happened then if after you made this factor, you didn't change, you just added into your model? What happens then when you tested out of sample from 2020 to period? Like, does it still actually work? You train the data, or you train your model on the data from 2010 to 2015, or 2010 to 2020. What happens after you put it into production from 2020 to 2026? Does it still have the same kind of effect, or does it still have the same results, um, based on your training model, based on the in sample training in the out of sample kind of real world test?
Hmm. Very interesting. Um, you know, I'm just trying to digest what you have just shared because again looking at different time period and different seasonality might resolve that orthogonal problem that I have mentioning previously. But as long as seasonality is a factor that can be a good isolation of the problem. Uh, correlation can still appear and in the market are not very chaotic. So that way or another, your hypothesis is still an hypothesis. It is still something that you assume to happen, or you assume that you think that might work in a certain market or in a certain environment that the market is actually in. So, how do you, after creating an hypothesis, how do you create a risk management system or risk management policy or whatever you would like to call it for that hypothesis in order to be sure to squeeze that hypothesis in the market, but still be able to scale if it will be possible, or to be very, very adaptable to market changes if the market are not the same that you have thought that they are right now.
Yeah, I mean, I think our risk management policy is maybe a little bit unique, but I mean, there are definitely things we do kind of at the IDEO level and things. So, I think we think that price is the greatest tool for risk. Like, usually the market's pretty correct. It's not too often you see like massive dislocations without kind of warning. So, in terms of risk, like we use pretty tight stop losses at the single stock level, and then have an overarching policy for the portfolio, which is kind of macro driven, um, which will tell us when to degross and denet down when periods of risk are elevated. And we look at things like how are risk on sectors that we design or risk on ETFs that we defined performing, how are higher beta kind of asset classes performing, how are credit spreads performing, and then how are more behavioral factors in the market performing as well. So I think it's two pronged. I think there's a lot of stock specific risk measures we have, which can be tight stop losses and in stocks. That's one of the things that we try to do is create this kind of asymmetric return profile, right? Where we want to cut losers quick and hold on to winners for longer, so that we can kind of recognize this positive skew, for a return profile, at least in the single stock level. And then also to understand, when is it time to get out of the way, where we recognize that there's just something too overarching in the equities market where it's just going to be risk off kind of for equities. And how do we get ourselves away from that basically, or how do we make sure that we're not going to be um, uh, how do we make sure that we are not kind of in front of a moving train basically?
Hmm. Okay. Okay, let's we'll circle back to that topic. I think later on, but I would like to touch on another important or another very interesting topic, which is retail sentiment. Now, I will not disclose the name of the company, but I was working as a project manager in a company that aims to take a bunch of analysts and to accumulate a sentiment out of it. And you were working in a company that will do the same, but with retail traders. So retail traders, or understanding their sentiment and to quantify the data is is a different mission than quantifying uh, analyst data. So I would like to ask you, how would you see the exponential participation of retail traders in the markets? What assets do they trade? How do they approach new data? How do they think of the markets, and how they're getting strengthened you know into different market environments, as long as the market is very chaotic.
Yeah, so I think there's two important points right there. So number one is how do you kind of quantify retail data? So I was lucky, one of the things I got to work on or build when I was at Seeking Alpha was this product called Top Analyst, where I basically got to clean and organize all of the underlying data or all the underlying rankings that Seeking Alpha had since its
Oh,
inception.
really?
So yeah, so it was pretty amazing. So I got basically everybody's ranking going back to the inception of Seeking Alpha, and I got to basically create this alpha capture service where I saw when did people perform well. There are obvious things. You know, I don't know exactly what it looks like right now. I can pull it up, but I'm sure a lot of the energy focused people on Seeking Alpha are performing very, very well right now, given that energy has basically gone in a straight line up since the start of this war. But you could really see who had persistence over time, and what was it that they were looking at. There's one guy who was very good in the small and micro cap space. There's another person who was amazing at banks. I mean, I think he's since moved on to have another career, but he wrote a pretty famous, call it famous, but he was talked about in a few podcasts, bigger podcasts like Chamath's podcast, the All In podcast. But this guy wrote an article on Seeking Alpha, basically outlining the demise of Silicon Valley Bank before it happened. So
Mm.
there are real pockets of information, and we'll call it alpha on Seeking Alpha. And if you can determine a way to how to score or read through and determine who you think has a really good process for stock selection, I think there's a lot that you can potentially look at and a lot of information you can glean from there. So it's not all just retail sentiment. It's who has a really good understanding of their coverage universe, and how can you create a process to make investment decisions off of that.
Mhm.
And there are a lot
It's
of like major, just I guess just to be clear, there are a lot of major funds who run these type of strategies, called alpha capture services. The most famous one is Marshall Wace. They're a huge, huge, huge company. I think they started in the early '90s, basically saying,
so
"Yeah,
so they're just receiving retail data and making investment decision based of it.
not just retail data, actually." So they have, I think they just for history's purposes, I think they started in the early '90s, basically, and I had this thought process. We receive tons of sell side research. How
Mhm.
do we determine who's actually good, right? So they started scoring this, and basically came up with a methodology to say, oh wow, there are a couple guys in here that are putting out really good data and have amazing track records.
Yeah.
Let's make a process over this. So they have a sell side arm now that does sell side research, and then they also have buy side. They actually will pay hedge funds or institutional investors, not just hedge funds, and it's institutional investors, research firms, basically to put in their stock selections on their website, and they'll pay you a reward based on your skill factor. So if you have a really good stock selection process for a specific month, or I think they grade it quarterly, if you have a very good stock selection process, they'll actually reward you for that and pay you a higher kind of bonus or reward for your skill factor.
Really.
So this notion of alpha capture services is kind of going on across Wall Street. Marshall Wace is, probably the most famous one. I could probably name at least three or four of the firms doing this, but there's a lot kind of that can be gleaned. They're doing it from Wall Street, but I think there's an opportunity potentially for somebody
Mhm.
to really commercialize this, especially as investing becomes more and more kind of mainstream.
Mhm. It's very interesting that point of view because this is exactly what the most famous firms are actually doing. Like Jane Street, Citadel. By the way, I'm speaking about things that we can speak about, and they're not disclosed. So if they're looking at Walmart and they want to enter a position in Walmart, that they are actually putting positions in advance because they have satellite photos. Are actually gathering all of the data. If it's retail participation, if it's other institutions, if it's information from the SEC. So they're actually looking at everything and they're zipping everything into a very heterogeneous data set that deriving investment decisions out of it is very, very, very complex understanding. So before the news release, they already set up their position in advance, and they already captured the wave even before you even think about it. Um, and that really awake the point of understanding different surfaces of data. So you have mentioned, surface data, which is the retail bias and different hedge fund holding period, which is a thing that we haven't really touched about, and I would love to touch about it together with you. And they are capturing lots of different data, zipping it, and deriving investment decisions, as we have already said. But that data is very heterogeneous, and retail is very, very different than hedge funds. And hedge funds is very, very unique proposition to the data set. And I would like to ask you from your experience about when you were intervening with the investment decisions in different hedge funds, and you have saw different holding positions. What do you think of an invest of a holding period? How would you set up or organize your position in a way that will be beneficial enough for the type of the hedge fund that is actually looking at the market right now in terms of obviously the holding period.
Yeah, I mean, I think in terms of holding period, I think there's a lot of factors going that kind of go into it, right? I mean, if you're, I think the most obvious number one is your signal, right? So is your signal predictive over 5 minutes? Well, if you're trading, price and volume, then or off of tick data, then it probably is, and maybe that's a really good edge you have. I mean, a lot of these HFT firms, like they make all their money just by capitalizing on latency. Like their server is an inch closer basically to the exchange's server than other people, so that's a really good edge that they have.
Mhm.
So their holding period can be seconds or milliseconds.
Or
But if you're
nanoseconds.
trading, say it again.
Or nanoseconds.
Or nanoseconds, exactly. So, but if you're trading, fundamental data, or you're trading an edge in, business model updates, or you're trading an edge in kind of macroeconomics, it's your holding period is likely to be much longer, right? Because, you know, actually the SEC just passed or is expected to pass something that says that the reporting period requirements are going to go from, 4 times a year to only twice a year now. So if you're trading that, your edge might be only realized after 6 months, right? Like after each reporting period, or now it's quarterly. If you're trading on quarterly earnings, that you think you have a better view of earnings or earnings reactions in the market, it's probably quarterly. So I think it really depends on the signal or the edge that you're trying to capitalize on, right? If you're trying to capitalize on latency, it's probably much smaller holding period times than if you're trying to capitalize on, earnings growth or business growth. I think there's a really famous chart that I love. I can send it to you if you want to post it, but it basically is saying that I think over a year, less than 50% of a stock's price movement is based on earnings. But if you expand that to over 10 years, over 99% of a stock's price movement is explained by earnings. So
Really?
yes. So I think the
And,
holding period question is dependent on your signal.
mhm. And who wow, okay. So if you look at the recent 10 years and you say that 99 of price influences because of earnings, which is really it just makes sense. Um I would like to understand. Okay, now you do know that what drives our price and its preciseness, it's earning data, and you know that previous earning calls are completely influential even until today. And today's market sentiment for that particular stock. Then we have spoken. I told you that we're going to be back to that cycle. You have spoken about different fingerprints as metrics of data, and I would like to ask you, since um, the matrix itself is like the data in the matrix is all calculated and stored and influenced by previous earning calls. How would you now think of the continuation of the stock, or how do you calculate or try to estimate or try to expect to a certain movement if you already know and you already have the most reliable data points, understanding that the earnings are the most influential factor that drives the most coefficient in your data.
So I think only focusing on that is a mistake, even though it is so powerful over time. But I think only focusing on that is probably a mistake. I mean, I think
Yeah, but that's your data by
what
the end of the day. No,
that's what.
that's the data that you have.
No, that's there's a lot of different, we take in a bunch of different data sets. It's not just kind of fundamental data. I mean, we do estimate data, ownership data, and then we built proprietary databases as well. But I think a great example, and I'm going to bring it up again because it's just so powerful and it just happened. But if you look at software, software has gone into a massive drawdown. It's rebounded a little, but I don't know where it is off its highs. Let's call it at least 25% off of its highs. Software earnings have not moved, right? Like they haven't reported yet, and they really haven't seen a change in their kind of backward looking earnings. And even probably in the next quarter or 2 quarters, they're not going to see much of a negative change. But what's happening is the market is pretty dynamic in pricing these things. And they're recognizing that, what was the moat that a lot of these software companies had? The moat was, well, they've had engineering teams building this product for 30 plus years to make sure that nobody else can replicate it. Well,
Mhm.
now with the kind of mass adoption or democratization of AI, you know, my barber vibe coded his own booking system. I used to have to
So,
call and make an appointment. He's a sharp guy. I'll give him credit where credit is due, but I think 5 years ago, that was a statistical improbability from happening. Basically impossible for him to do that.
mhm.
Now he did it, and it's amazing. I can make appointments. I can cancel appointments. He had the AI build a ranking system for his customers based on who's the most loyal. Like the advent of this is unbelievable. And the moats that I think this market was pricing 5 plus years ago have been decimated because of how quickly this adoption has happened. So I think just looking at backward fundamentals in isolation probably is not a good idea, especially with how quickly things are kind of evolving in these markets.
So how do you create a data set that's enough reliable? You said that you take a bunch of different data sets and you derive different conclusion for each and every single data set in order to build a very diverse data set as it is to create fingerprints and the matrices over. So how do you actually derive from the same data set different factors are completely beneficial for your decision-making process.
Yeah, I mean, how do you derive it? I think that's part of what we touched on before, but I think it's making sure that your factors are orthogonal, right? Like making
Yeah.
sure
Well,
you have a predictive factor and it's not going to capture the same thing as another predictive factor that you have in your model. So I think it's just making sure what you're focusing on is orthogonal from each other and you're not just making kind of levered factor bets or levered stock bets. That's I think that's really, really important.
mhm. Okay. Okay, speaking about your experience, S&P Global Market Intelligence, quantitative
Mm.
analyst, investment management is your last role, which you have been serving for 3 years. How it is like to work in a company like S&P and doing some and being a quantitative analyst there and investment management. How it is like? How it's dynamic is how the dynamic looks like when you work in such a company. And yeah, please, let's explain more.
Yeah, no, S&P is an amazing company. Got really incredible experience there. And I think one of the best things I got experience from there is I got to sit down and have really personal relationships with a lot of front office investment individuals. So, portfolio managers at pension funds managing, more money than I can even fathom at one point, right? Like some of these pension funds have, hundreds of billions of dollars under management. Insurance companies, anyway, I think part of it is recognizing that there's just such scale at a lot of these money managers, number one, and then that can influence investment decisions. So I guess touching back on holding period, if you're trading tens of billions of dollars, you cannot move as swiftly as somebody managing, tens of millions of dollars because the liquidity just isn't there for you, right? So I think that's another reason that your holding period might have to shift if the liquidity isn't there for you to be as swift and as nimble as
Mm.
others. So I think just working at S&P, getting to have these personal relationships and understanding what drives um, people's businesses was really interesting across the investment management space and across the kind of asset owner and asset owner space as well. And then the other thing was very cool is S&P has three different divisions. So they have the market intelligence division, which is their data division, which is where I worked. They have the credit rating space, which we had a lot of overlap with because people would use credit ratings, to make investment decisions. There's a lot of kind of predictive flows in the equity based on what's happening in the credit markets, and then also they have the index division, which obviously, I would say there's a massive amount of people that benchmark or at least care about what the S&P is doing on a day-to-day basis. So I think working there really allowed me to see or get a good view of kind of what's going on across all of capital markets. And they have other divisions now. They're have an ESG division, and then they have different kind of underlying businesses as well. Like Platts is like a leader in the commodity space and commodities data. So they really are all across capital markets from end to end. And I think working there gives you um, a really good understanding of all the different businesses that touch capital markets and how they all kind of intersect with each other.
Mhm. Okay. Well, obviously, an experience like in S&P is very important to in terms to look at different pension funds, managing bunch of like as you said, billions of dollars that you even can really say the number correctly.
Mhm.
Um, because it's that large.
Yeah.
But just from your experience, from the division that you are working in, um, meeting or having like a certain introduction to those pension funds. Um, and the interaction with S&P. Can you please, explain us, explain me and the audience what is actually took part in those type of calls? What was, the major drive, in terms of like what's actually the interest in between, because I think that even if and that's a complete direction to understanding how exchange rate and HRT and other HFTs are working on daily basis, is like to understand what's actually standing behind the data. So I'm trying to understand what's actually standing behind, their relationship in order to understand what actually drives the market.
Yeah. So I think it's twofold, right? I think it's first understanding kind of how different businesses operate, right? So a pension fund is gonna, they're basically trying to solve for their have future liabilities. So they have this asset liability mismatch and they're trying to solve for that. That's going to be very different than um, a RAA or wealth management fund who they don't have, you know, I guess they are going to have future liabilities eventually, but really they're just trying to, maximize their clients' kind of value in their account. So I think it's understanding what type of client you're talking to, and then understanding kind of how you can help or how you can fit into their workflow, so that going forward you can help them build a stronger business, help make sure that their strategies are working well, are still maintaining the edge that they want, and then how they want to grow. So right now they have a large cap growth strategy. Maybe they want to get into emerging markets or get into small cap. So what are differentiated data sets that are going to help you do that, right? I mean, it's very difficult to move a model from North American focused companies to Asian or even European companies, especially in emerging markets, because the data is much more sparse, right? In the US, at least for now, you're required to report 4 times. In Europe, in Asia, you're only required to report twice. So you have semi-annual data.
Mhm.
So how do you account for that major change? And then also there are different reporting requirements, right? In the US, there's gap reporting requirements, and in I think rest of world, but definitely in Europe, it's IFRS. So how do you kind of compare those two across each other if you're running kind of a global strategy? So I think a lot of it has to do with understanding your client, understanding their needs, and then understanding where and how they want to grow in the future.
Mhm. Okay. Interesting point. Touching on our last topic for that conversation, Chief Investment Officer in Vineyard. Obviously, we have already spoken about what Vineyard is actually doing, but we haven't really spoken about as your role as a CIO. And obviously, you have been through a lot until you have converted on being an investment officer, Chief Investment Officer. What do you think is actually a necessity? And we have touched about it, but I would like to understand a much deeper perspective. What do you think it's actually necessary to have as a skill set in terms of a financial background, but not a very data science or a scientist or like scientist background. What do you think it's the most important factors to have in mind in order to understand the market, in order to understand the landscape? Because as you have mentioned right now, yeah, like Europe has its own policy, the US has a completely different policy, and then you would have to gather and make a certain congruency in between all those policies and to understand how the landscape is actually changing and shifting. So I would like to understand from you, like financially, or in a measurement of economic background, what do you think of the necessity of the level of understanding that you would need to have in order to be a very, very good chief investment officer?
Yeah, I mean, I think there's a bunch of things that go into it. I think, and maybe one of the hardest things to realize. I think when I set off in this endeavor, I think I was squarely focused, or maybe had even too much of my attention on just kind of making sure that the investment strategy was going to work, and making sure you had good returns, and it was very squarely focused on that, and quickly came to realize that's a piece of it. I mean, having good returns, good risk adjusted returns are that's table stakes. I think there's a lot of people that can have that. It's then being personable, developing relationships, showing how you can solve problems for asset allocators in their portfolio, and help their business by introducing them to your strategy. I think is a big piece of it. And then also, right, it's as much as it is about investing, it's also about running your own business. So there are things that are constantly changing on your side too, right? Like if your vendor is going to change something, how does it affect your day-to-day processes? If your investor needs something new, how can you change what you're doing to serve their needs? If you're I just think on a daily basis there are things that are constantly changing, that are outside the scope of finance or making investment decisions, that are required to kind of run the business. And I think that was something that I didn't initially think of, but quickly was introduced to. So I think that's a really important point for people to understand it. Just as much as it is about having a successful strategy, making sure you understand the data, making sure you understand your strategy. It's also about running the business and making sure, kind of on the operation side, that things are running smoothly. And it's actually a really good point. I think part of the reason that we saw this dominance in multi-strats is because of their operational alpha. They had huge resources behind them, in both in people and in money and in capital. And now with the democratization of AI, I mean, there's things that I have Claude doing for me that would have been a full-time job for somebody. So I think that the shift away from that is people are starting to talk about that, but I think that's an interesting topic if you want to have somebody more knowledgeable on that. But I see a lot of people spinning out of multi-managers now to make their own shop. And I'm wondering, is there a correlation between AI agents and people spinning out of shops because they think they can just accomplish so much more on their own?
Mhm. Very interesting topic. Just before we go, I would like to ask you one little question. You have mentioned, and that's a topic that I do speak about very much on you. Well, it's unavoidable, but about the rise of language models and their assistance for doing some research. And you have mentioned that what is clear, what Claude's what Claude is actually able to provide you nowadays is completely changing or replicating someone else's job. And I would like to ask you, how would you, obviously, as a thing you would like to utilize, that certain capability, in the very best manner. I would like to ask you, how do you actually utilize language models in your day-to-day job in order to get the rightest data? Because making work or some doing some research with those language models can be a little bit misleading in some cases. So It's a bit tricky. I don't really need to explain about hallucinations, about how large modules are actually being generalized by the end of the output. But still, it's a very complex task, and I would like to ask you, how would you actually leverage it properly?
Yeah, I think you're hitting a very good point. I mean, the hallucinations I think are difficult, and I think one of the
By the way, we as humans, we hallucinate most of the time.
100%, but I think that the big point that's missing right now is that, or at least the thing that keeps me afraid of it, is the auditability, right? Like if you ask, and I encourage you to do this, but if you ask any LLM, whether it's Claude or ChatGPT or whoever, what is the something very simple? What is the 3 month correlation between, you know, oil and the S&P? It does not calculate the 3 month correlation between oil and the S&P. It goes
Because it's
out
not
and it
unified.
checks websites to
Yeah.
see, right? It doesn't actually
It
do the
retrieves
work.
data. It doesn't make any calculation. Well,
Correct.
he makes calculation, but he is unable, just a quick recap of what actually happening right now. So, LaCoon, he won, that's the equivalency of a Nobel Prize, but for math, and he was dropping out of Meta. He was the head of research at Meta, and right now he's established AMI company like AMI Research, which is a company that aims to take real data like video, photos, everything, and to have like a real intelligence behind all those models, and to enable those models to actually process and derive the rightest output out of real-time data and not from text. And not being able, like for nowadays language models, which LeCun claims that they're completely built for failure, and that's quote unquote, obviously. So having the understanding that language models are unable to calculate and to make this decision, but they are actually retrieving data, is a thing that you would have to have a proper due diligence over. So still, it is a ton of work for you to do.
Yeah, no, I think that's a good point, right? I mean, I think we're at the precipice of where AI is going. Um, I am using it constantly, and I think helping to train these models by telling it what they did wrong or what they did right and giving it positive or negative feedback. So I think there's a
You're,
long way to
you,
go.
you, you're currently helping them. This is
Correct.
how we
Yeah,
work.
exactly. Exactly.
Verifiable
Exactly.
rewards.
Right. Exactly. So for good or for bad, I think they're only going to be in more demand. I think people are becoming more reliant on them. Um, but the question is, how much can you trust them? So I always go back to the point. I really don't use them in my investment process. I use them more to evaluate kind of the process
To
and
evaluate.
to evaluate the
Okay.
process and but not kind of make investment decisions. Maybe in the future, but I'm just not comfortable with it yet. And I've asked this question to many people. I'll pose it to you if but the question was, if AI had to make a life or death decision for you, would you trust it with the outcome?
No.
Right. I haven't had anyone say yes yet. I imagine that will
I,
eventually
I, I
change.
I won't be able to count on a doctor like to make liver dead decision.
Right. So I imagine that this will eventually change, but I think we're not there yet. And I think one of the things that scares me so much is, right, and we talked about this or touched on it, that it doesn't calculate things itself. So it's very difficult to audit kind of the where things came from, right? Like even if you ask it something as simple as 2 plus 2, like it doesn't calculate that itself. It goes out and finds the answer to it. So if it finds incorrect data, it's going to confidently spit that back out at you.
Mhm.
And I think that, to me, that's a very scary thing that's happening right now because there is a lot of misinformation on the internet. Um, right? I mean, the internet hasn't been 100% audited. It's impossible. So I think until we get to a point where it can confidently calculate things for you and then tell you, I got to this answer by doing this, it's hard to understand or
Hard to get
trust
that.
the
It's hard to get
exactly
that of the facts.
hard to rely on it. Yeah, exactly. So I think there's a lot of auditing kind of due diligence needed before we can kind of take the next step.
Mhm. Yeah, well, brilliant, brilliant. I completely agree with you. I do think that, proper due diligence over its outputs, it's more than a necessity. And I completely agree with your proposition about about how to work with them reliably. Zach, I really want to thank you for your participation. It was very, very great to have you. Thank you.
Yeah, thanks for having me. I'm excited to listen to your next podcast. I love what you guys are putting out
Appreciate
and the
it.
content you're making. So I'm excited.
Appreciate it. And again, thank you. It was a pleasure, and I'm glad for the opportunity. And guys, until next time, uh, thank you for listening. Thank you, Zach. Thank you, everybody. Thank you, everybody, and see you next time. Thank you.